So, welcome to Financial Technology, a certification level 2 class. Some quick logistics. You should have received a pre-survey on SurveyMonkey. If you have not, please do that by the end of today. We are scheduled to go from 10 a.m. to noon. That's always a more generous time frame than we need. My goal is always to get you out of here before noon. If you have not already, please mute yourselves. And if you have not already, please use the chat as a sign-in sheet of sorts. So I'll just wait a second for any last minute people to throw their names in the chat if you have not already. And I will go ahead and apologize up front. I have got some kind of issue going on with my sinuses. So if you hear me sniffling, I do apologize. So let's launch into FinTech, financial technology. Again, first, please know I am not an expert in this field. So anything I pass along today should be considered not as advice, but just as knowledge that you should also research yourself. And unfortunately, this class is heavy on info and light on interaction, but that does not mean that you should not stop me. If something doesn't make sense or you just have a question or a comment, please stop me at any time. So financial technology, often shortened to FinTech, is the tech and innovation that aims to compete with traditional financial methods in the delivery of financial services. Broadly, it describes any company using the internet, mobile devices, software, or cloud services to perform or connect with financial services. It is an emerging industry in the last 2 decades that uses technology to improve and automate the delivery and use of financial services. At its core, fintech is utilized to help companies better manage their financial operations, processes, and lives by utilizing specialized software and algorithms. The most talked about and most funded financial technology startups usually share the same characteristic. They are designed to be a threat to, challenge, and eventually usurp entrenched traditional services. They usually do this by being quicker and serving an underserved segment or providing faster or better service. According to a 2017 survey, 1/3 of consumers utilize at least 2 or more fintech services. And those consumers are also increasingly aware of fintech as a part of their daily lives. Fintech now describes a variety of financial activities, such as money transfers, mobile depositing on your smartphone, bypassing a bank branch to apply for credit, raising money for a business startup, or even managing your investments, generally without the assistance of another human. So there are kind of 6 key areas of fintech. We're going to go over most of them today lightly. There's peer-to-peer lending, crowdfunding, cryptocurrency, robo advising, mobile payments, and mobile banking. So the first area to go over is mobile banking. Modern banking apps are making trips to branches unnecessary. According to research from Jumio, 76% of baby boomers bank online, where millennials are only 1% more at 77. Now, you can even send and receive money straight from your banking app. If you happen to get a check, you can take a photo of it and deposit it from your phone. Once upon a time, all these features were considered cutting edge, but now we expect them as part of our mobile banking service. The right online banking platform should allow you to transfer money, usually via email, social media, text message, or another mobile banking app. Check your account balance and access your history. Find the nearest ATM within your bank's network. Research other products and services offered at that institution. Look at different services like currency converters, home loan repayment calculators, or even stock trading calculators. They should allow you to pay for goods and services with a mobile wallet. And again, they should allow you to deposit checks and pay bills. So make sure to utilize a lot of the advantages of mobile banking. Set up direct deposit. Utilize special bill payment and money sending services like Zelle. And utilize virtual check depositing. But please be sure to dispose of the check properly once it clears. You are still taking care of a very important piece of financial information there. Can anyone tell me what's the proper way to get rid of a check once you've done a mobile deposit? Anyone know? All right, I got one in the chat for shred. That's one step. You are correct. What do we do before we shred it, though? Void and shred, that's correct. So we're going to add a little extra step to it, though. With void, you can write it one big time across the entire check or many small times. Do it in a Sharpie, a permanent ink. That will always leave some kind of imprint that Sharpie will. People can try to bleed it a regular pen ink, but not a Sharpie. And then you can rip or tear or shred it, whichever one you prefer of those methods. Make sure to throw them in separate trash cans. Make it that little bit harder to put that check back together if someone really wants to. So the pros of mobile banking, well, it's very convenient. It saves you time, saves you travel. It can be easy to use, and all necessary information is usually right in front of you on your phone screen. The negatives are, well, there are some security concerns with the rise of hackers and phishers. This is more so from your computer and laptop than from your phone. To let you know, most mobile financial institution apps are probably the most secure app on your phone. But with websites, it can be a little bit trickier. So just know there is an issue with hackers and phishers when it comes to accessing your account through your desktop or laptop. There can be an issue with customer service. And a lot of places now are working with live customer service on their websites, but many may not. You may still have to go through the 1-800 number. And there at times can be glitches, and your institution may not be catching up with the rest of the herd when it comes to what they offer in terms of lack of service. The current situation we are in kind of highlights the necessary knowledge and use of mobile and online banking. Many institutions are closing branches or limiting in-person interactions. Some are starting to open back up, but many are still utilizing only drive-through access. Early signs have indicated the pandemic could speed up the digital banking trend, and has. Bankers generally are reporting that digital usage is rising alongside with the proliferation of the virus. In some cases, it's surged. 82% of respondents to an FDIC survey were concerned about going in person to their bank, and 63% were more inclined to go through a digital app. Digital offerings, a generation ahead of where they were during the last economic downturn, have enabled banks to provide uninterrupted service during this pandemic. So if you're looking to try to do some comparison among mobile banking and the different institutions, look for the user friendliness of the site. Test how easy it is to find what you need to find. Look for speed, accuracy, and convenience. Look to see how easy it is to apply for new products and services. In some places they may still require you to come in, and that may be uncomfortable for people. So look for that ability to apply for new products directly through the website or app. Your bank should publish its security measures online, letting you know how it's going to protect your sensitive information. Your bank should guarantee your funds also against any cybercrime. Look at the range of features they're going to offer. Top banks allow you to check your balances, pay off bills, and sign up for auto pay, among other perks. And a good online banking platform should offer phone support or live chat during their business hours, and at least some form of customer service outside of their business hours. Also, in the last 2 decades, there's been a new form of financial institution that's come into existence called the direct bank or online bank that only exists in the online and mobile world. Ally is probably the most well-known. Discover, the credit card company, also runs Discover Bank, and there's also Access Bank. So these online or direct banks, they usually have better rates and lower fees because they have less overhead cost without having brick and mortar branches. They also tend to have better tech and online experience concerning their apps, websites, and overall technology, since that is where the only place they exist. But the downside is, well, there's an absence of direct ATMs. You're likely to be a part of a network like Allpoint or MoneyPass. Making cash deposits can be difficult since there is not usually a brick and mortar branch to go to. And you have that less personal relationship touch if you run into an issue. There's not a branch down the street you can go to. Most of the time, you're going to be talking to someone who may not even be in the same state or sometimes the same country as you. So in terms of the future of mobile banking, we may have crossed the Rubicon, so to speak, in terms of in-person banking. Many financial institutions may lessen their brick and mortar branch offerings, and many customers may never look back from primarily using digital access once we kind of start to open back up and return to a new normal. But the question is, does everyone prefer primarily using mobile and online banking? A CFPB survey found the most satisfied customers were those who primarily used the digital access only. But interestingly enough, the second most satisfied group were those that didn't use mobile or online banking at all. So it's going to be interesting to see where we go in the next 3 to 5 years as we begin to open back up and really become a full and open society again. Whether bank branches are going to fully open back up or go back to that 100% level they had pre-pandemic. So any questions on mobile banking before we move forward? I know that was kind of one of the easier ones to go over. So our next section is going to be on mobile payment services. So a mobile payment is a money payment made for a product or service through a portable electronic device, such as a tablet or cell phone. Mobile payment technology can also be used to send money to friends or family members. In fact, according to Statista data, the global mobile payment market is on track to surpass 1.3 billion users by 2023. Mobile wallet services and pay by phone apps increase the usage of mobile payment services. The most recognizable one of these is probably PayPal. It simply has both the largest number of services as well as the highest level of functionality. It has long functioned as a convenient payment system connected with eBay. But it has since evolved into perhaps the most commonly accepted payment method on the internet. And there is no fee to transfer money to or from family and friends who also have a PayPal account. And the fee for transferring funds to or from those who do not have a PayPal account is minimal. And there is also a fee to send it to products or services that I believe is less than $5. Venmo has become one of the more popular ones recently. It's the most popular app for sending money among millennials. You can send money from the app to mobile numbers, email addresses, or even Facebook accounts. And you'll only incur a fee if you use a credit card to send the money. Google Wallet is another one. You send people money to their emails or phone numbers. Recipients get notified by email and then go through a process to verify their identity in order to accept the money. And there's also Cash App, which allows users to request and transfer money to any other cash account. And then users can choose to withdraw the money with its debit Visa card, a cash card, or transfer it to any local bank account. Zelle is usually one of the most used ones as well. It offers a unique way to pay friends or family right from your bank. If you have an account at a participating bank, you can send cash with same-day transfers to anyone else with an account at a participating bank. The growing list of participating banks includes Chase, Bank of America, Citi, US Bank, Wells Fargo, and online banks such as Ally and Capital One. You can even send without installing the actual Zelle app on your phone. You're usually able to utilize it through your financial institution mobile app. Samsung Pay is the mobile payment service for those with Androids. It allows users to load their credit, debit, gift, and loyalty cards so that they may use their phones to pay in stores. It uses a technology called magnetic secure transmission. It allows Samsung Pay to use your phone to mimic a physical card swipe, allowing you to pay anywhere you usually pay with a card, which means it's accepted virtually everywhere. And since there's Samsung Pay, there's got to be Apple Pay, which is very similar in structure. You can store up to 12 different cards on the app, including even a student ID. Apple Pay gives you the ability to make purchases online, in stores, and in the Apple app, as well as making person-to-person transfers. There are no fees to use the service unless you are using a credit card. So here is the ratio as of 2018 of the payment methods in the United States. You see credit cards are king, cash right behind it, debit card, check, and then we start to see the rise beginning of the mobile payment services. PayPal, surprisingly, 44%. Apple Pay at 9%, Venmo 7%, Zelle 6%, Google at 6%, Cash at 3%. And I can only assume that with everything going on as well, these numbers have skyrocketed in the last 3 years since the CNBC survey. So the pros of using a mobile payment service. They are easy to use and generally quick to set up. They lessen the risk of you losing your physical cards and wallets. And they can be safer than plastic. Most apps generate a unique barcode for each transaction instead of sending your card digits into the internet. Well, the cons are you can't use it everywhere. Just because a retailer can accept mobile payment services doesn't mean they will. You do need the newest technology. Most of the old and lower end smartphones have some compatibility issues with mobile payment services. And what if you lose your phone or it breaks and you're not carrying your physical wallet? You're literally out of money. Something interesting is many people have gone entirely digital in managing their finances between mobile payment services and online banking. Some even only manage their finances through mobile payment services and do not utilize financial institutions. It's important, though, for us to pass along the importance of the safety and security that financial institutions offer that these services cannot and may not. Another note on the future of mobile payment services is, again, just like online banking, the pandemic has only accelerated the trend in use of these services. With vendors going cashless at the beginning of the pandemic, many consumers switched entirely to virtual wallets and similar services. So one has to wonder if there will be a return to spending cash confidently once requirements begin to be relaxed again. So any questions on mobile payment services before we launch into money management apps? I'll do a quick check of the chat and see if there's anything that's popped up. All right, seeing none, we'll launch into money management apps. Who could tell me right now where every dollar of the previous week has gone that you've spent? I'm going to assume very few of you are raising your hands because I can't either. But you don't have to. Technology will do it for us. Maybe you're, maybe afraid you constantly overstep on your budgeting categories. Let a money management app keep you alert to where you are. One of the most common uses of Fintech in 2020 was money management apps. Before, consumers had to create their own budgets, gather checks, or create spreadsheets to keep track of our finances. Now consumers can easily and efficiently keep track of our income, expenses, and use budget tools that have revolutionized the way we think about our money. Mint is probably the most popular of these money management apps. It's a free app from Intuit that's an effective all-in-one resource for creating a budget, tracking your spending, and getting smart about your money. It asks you to connect all your bank and credit card accounts. And you can also type in all your monthly bills, so all your finances are tracked in one convenient place. Mint lets you know when bills are due, what you owe, and what you can afford to pay based on the funds you have available. Users can add their own categories, track bills, split transactions, and set budgets that alert them when they're exceeding their maximum spending threshold. It comes with a customizable budget feature and a free credit score. And with Mint, you get the access to the app and the website at the same time. So this is what your dashboard looks like on Mint. You can see what I like is it keeps a running total of your accounts. You know, where you are with your cash, your credit, debit, or investments. You know, it's got, I love the bar graph kind of features that show you how much you've spent on these different budget areas. It's got a list of your recent transactions, and I love the spending wheel, which shows you, you know, where your money's gone in this chart. Another popular one is you need a budget. The company offers a free trial for 34 days, and after that, the cost is $84 per year. After signing up, you create your first budget and assign every dollar a purpose. The goal is to eventually get at least 1 month ahead, so you're spending money you earned from 30 days ago. The company offers extensive educational resources and customer service and support to help keep you on track. So this is kind of what the You Need a Budget dashboard looks like. Again, I love these graphics where it shows you the percentage of your money and where it's going. Simplify by Quicken is a newer app. It offers a free 30-day trial, and then you'll pay $2.99 per month. To get started, you sync your bank accounts to it. The app automatically categorizes your spending, tracks recurring bills and subscriptions, and stays on top of your upcoming expenses. One standout feature is the app's custom watch list, which allow you to limit spending by category or by who you're paying. Pocketguard is a free app that also offers a paid or premium version. The company uses an algorithm to track your income, expenses, and savings goals to tell you how much you can spend every day. The app can see what you are spending, can see where you can save, and reminds you when credit card bills are due. The app offers a smart bill reminder to keep track of due dates and shows where you may be able to negotiate for lower bills. There's also an automated savings feature, which allows you to set a goal and save for it. Pocketguard automatically moves that money to an FDIC-insured bank account on your behalf. Some other possibilities are EveryDollar, Clarity Money, and Good Budget. You're recommended to go for the free apps. There are so many free apps out there. Unless you really love one of the paid apps, you can always get the same, almost the same service at the free ones. You will need to manually enter cash purchases. These apps do not know when you're spending cash, and honestly, I think it'd be a little creepy if they did. You know, you stop at Thornton's and your phone buzzes. I see we stopped at a gas station. I don't see a purchase. What do we do there? That'd be kind of creepy. So you are going to have to manually enter your cash purchases. Otherwise, your spending tracker and budget isn't complete. Look for the ones that include a credit score. Please know security is tight on these apps and sites. And make sure your goals align with what the app focuses on. So, you know, you saw some of the apps I mentioned there had a savings focus. That may not be what you're looking at. So make sure they align with what you're looking for. So any questions on money management apps before we move forward? Right. Seeing none in the chat, I will take none. Let's talk about one of the ones that's made a lot of noise in the past 2 years, which is robo advising and stock apps. Robo advisors, also known as automated investing services, use computer algorithms and advanced software to build and manage your investment portfolio. These robo advisors have disrupted the stock market sector by providing recommendations and portfolio management that have increased efficiency and lowered cost. Perhaps one of the more popular and bigger innovations in the fintech space has been the development of stock trading apps. Before, investors had to go directly to a stock exchange. Now, investors can buy and sell stocks at the tap of a finger on their mobile device. And with inexpensive and low minimum apps like Robinhood or Acorns, investing from anywhere with any budget has never been easier. So Robo Advisors offer low fees and will manage your investments, taking guesswork out of the process. They offer low minimum deposits and often are simple to use. Some apps require as little as $1 to get started, and some fees are as little as that same dollar. While these apps cancel out the excuse that you need a ton of money to start buying stocks and investing in the market, they aren't 100% beneficial for everyone. The downsides are that you could be investing too little due to the lower cost, and often you'll be dealing with limited account options. If you decide to raise your investing amounts and increase your account, well, that can come with increased fees. Probably the most popular one and also the most controversial is Robinhood. They offer free stock trades. While Robinhood does not give you access to a full range of investments like mutual funds, it's great for stocks and exchange traded funds. And it even supports a handful of cryptocurrencies like Bitcoin. The core features of the app are focused on tracking stocks you own or ones that you place on your watch list. Its pros are that it has commission-free trades, no minimum, and can be easy to use. Cons are it lacks investment types such as retirement and mutual funds, and they have had limited customer support issues. So here's what your dashboard would look like if you use Robinhood. You can track stocks either that you own or that you may have pending stocks, as well as you have a watch list. Stash is a popular one. If you want to make your own investment decisions but need some help learning the basics, Stash is a great choice for that. It lets you start investing with as little as $5, and it helps you pick your investments while educating you as you go. The app is filled with articles and tips to help build your knowledge. You can choose to trade single stocks or ones that are bunched into various investment themes, like innovation or environment. There are plenty of investment options, but it's best suited for long-term investing. Acorns, well, it's based on automatic saving. Basically, every time you make a purchase with a card, you're connected to the app. Acorns rounds it up to the next highest dollar and automatically invest that rounded up money in a portfolio of low-cost exchange-traded funds that you select based on your risk preference. Acorns puts your pocket change to work in an utterly painless way. According to the app, there are more than 7 million users as of February 2020. It is great for beginners with a hands-off investing approach, but it does only have a few investment choices. SoFi, short for social finance, offers loans, banking, and investments through a convenient mobile app. It's ideal for investors looking to learn about stock trading. It offers commission-free trades and fractional shares, as they call them, stock bits, in an account with a low $1 minimum requirement. It has a learning section that has articles that are part of the SoFi investment tab, and you can also browse collections of stocks and funds to help you decide what to buy. I highly recommend you use an app with virtual money first. Trade Hero and Stash allow you to learn on a fake portfolio, so you aren't spending money to test out strategies. The virtual money are simulators who use real-time data to show you whether your investments will earn a profit and give you confidence in your investing without actually having to spend any money. The beginning of 2020 created a unique moment for retail trading. There was increased market volatility, there were stay-at-home orders, and zero commission fees across a lot of trading platforms created a surge in stock trading and an increase in first-time traders through these apps. These first-time traders, mainly in their 20s and 30s, found the stock market accessible. High prices, or at least the vision of high prices, had kept many on the sidelines for years. But for the first time, young investors felt they had the power to trade and make their own decisions on how to invest their money. The new generation of investment apps not only shifts stock trading services to a mobile and more technologically advanced environment, but it is completely reinventing the customer experience itself. Instead of using traditional trading channels with established intermediaries and standard fees, these new apps provide investors with a fresh way of gaining direct access to the stock market. So what you should look for in these apps are access on all types of devices, should be easy to use, You should be able to manage all of your investments on your phone. You should have access to buying and selling orders through your phone, fast and accurate trades, and you should have some research and educational tools to look through. Call customer service before investing. Most of these style of apps have less than stellar customer service, though it is improving. Call ahead and grade them on, how easy was it to talk to someone? How quick were they to assist you? How long did it take to get a physical representative on the phone? So, wrapping up the stock apps, the positives are they have lower cost and smaller initial investment. You usually have instant and 24-hour access to your stocks. There are free demo options, and you're helping to erase the middleman. The negatives are, well, you've erased the middleman and their expertise. Apps may have cash out limits. We saw that with Robinhood during the pandemic. And you may get hit with a tax bill you are unprepared for that previous middleman could have helped you get rid of. Any questions on those stock trading apps and Robo Advisors? All right. Jerry has thrown in the chat that he highly suggests folks read Whiplash by Joy Ito. Great suggestion, Jerry. Also, feel free, if you guys have suggestions like that, throw them in the chat. This is a community learning experience. So now we're going to launch into cryptocurrency. And this photo sums me up too. I don't know how Bitcoin works, and at this point, I'm too afraid to ask. So what is it? Simply stated, a cryptocurrency is a virtual currency, which, as its name indicates, uses cryptography to secure financial transactions. You know how your everyday government-based currency is reserved in banks, and that you need an ATM or a connection to a bank to get some of it out or transfer it? Well, with cryptocurrencies, you may be able to get rid of banks and other centralized middlemen altogether. That's because cryptocurrencies rely on a technology called blockchain, which is decentralized, meaning that no one single person or entity is in charge of it. Instead, every computer in a network confirms the transactions that occur on an open list that anyone can check. Bitcoin is the most common form of digital currency, but there are over 6,000 different types of cryptocurrencies since Bitcoin started at all. Bitcoin users exchange these digital coins for goods and services or trade them for cash. Well, how do we acquire it? Well, through a process called mining. And no, you don't need a hard hat or pickaxe. It's kind of like a video game. Developers compete to answer difficult math puzzles to win more Bitcoins through specialized software. The first to crack the code is rewarded by being able to create the blockchain or the open list. Again, the blockchain maintains records of all cryptocurrency transactions on that network. But again, it still has no central leader or third party controlling it. What's the catch? In order to mine, you're going to need a computer with very specialized hardware and software. So cryptocurrency can be stored via an offline cold wallet or an online hot wallet. Ease of access makes hot wallets a more desirable option for the beginner investor, though they're also more susceptible to being hacked. Cold wallets are not able to be hacked if set up properly. Technically, you're not even storing units of cryptocurrency. Instead, it's the private key that you use to sign for transactions that needs to be securely stored. Think of it more this way. You aren't storing your bills or coins, but you're storing your signature. Law enforcement agencies, tax authorities, and legal regulators worldwide are still trying to understand the very concept of crypto and where exactly they fit in existing regulations and legal frameworks. A lot of concerns have been raised regarding cryptocurrency's decentralized nature and their ability to be used almost anonymously. Authorities all over the world are worried about the cryptocurrency's appeal to the traders of illegal goods and services. Moreover, they are worried about their use in money laundering and tax evasion schemes. So some pros of cryptocurrency are it has unparalleled transparency. While the use of cryptocurrency is anonymous, the transactions themselves are all stored on an open list. This means that the data is available to view by anyone at any time, and that's a major boom for those wishing for a more transparent banking system. You have instant and 24-hour accessibility. Though largely unregulated, it is legal. You have low transaction cost compared to other digital payment methods, and it's not subject due to inflation because it's a controlled creation of currency. So one thing to mention is this: Bitcoin is not infinite. When it was created, only a certain number of units was created. So when all the Bitcoins are mined and found, that's it. You don't just print more like you would money. Well, the downsides, it can be difficult to understand, especially with thousands of different types. There is no security in case of loss. There is no way to recover coins if they are lost stolen, and there is no system in place to protect the value of the coin. You have the potential for security breaches due to the digital nature. The value of cryptocurrency changes, and laws on how to claim them as taxable income are fuzzy at best. And cryptocurrency, if you wish to use it, is only accepted by certain vendors. And then both a pro and a con is the absolute anonymity. Having an unregulated currency that is not bound by customs adjustments and fluctuating political changes is a positive and a negative. While the additional layer of security that the anonymity provides is an excellent benefit, it has also led to the inevitable adoption of the technology by the criminal fraternity. Black market and dark web are big users of cryptocurrency. It's also very volatile. This is the definition of a high risk, high reward investment. So what do the experts say? Dave Ramsey says Bitcoin falls under the don't invest in something just because it's hip, cool, or trendy rule. If it's too hard to understand how an investment works or how its value rises and falls, steer clear. The CFPB stated virtual currencies may have potential benefits, but consumers need to be cautious and they need to be asking the right questions. Virtual currencies are not backed by any government or central bank, and at this point, consumers are stepping into the Wild West when they engage in the market. Jim Cramer of CNBC's Mad Money has infamously called it monopoly money, but has recently been telling people to buy Facebook as it will be launching a cryptocurrency soon. So if you are going to jump into the cryptocurrency world, some basic tips. Don't place all your crypto coins in one basket. You can diversify among the different types and categories. Opt for an alternative personal email. Using your regular email account places an investor at an unnecessary risk of a data breach. Only invest money in it that you can afford to lose, because it is a very volatile market. Use a cryptocurrency exchange or broker where you can buy and sell the cryptocurrencies, and do your own research. All right, any questions before we move on? I know that was one of the more probably confusing and complex ones. All right, seeing none, we will move on. Crowdfunding is also a part of fintech. It's crowdfunding or collaborative funding via the web is one of the standouts for growth in the evolving collaborative economy. Billions are raised each year across the various sites and organizations. These platforms allow internet and app users to send or receive money from others on the platform and have allowed individuals or businesses to pool funding from various sources all in the same place. Instead of having to go to a traditional bank for a loan, it is now possible to go straight to investors for support. There are two main models or types of crowdfunding. The first is what's called donation-based. The birth of crowdfunding has come through this model, where funders donate via a collaborative goal. The second and more recent model is investment crowdfunding, where businesses seek ownership stakes. In this model, individuals who fund become owners or shareholders and have a potential for a financial return. Causes is the world's largest online campaigning platform focused on social, political, and cultural issues. Patreon is, as opposed to you collecting one-off campaign donations, it's more of a subscription-based model where patrons regularly contribute a set amount of money every month or per item created. And then there's Gofundme, which is universally known for its personal fundraising. Kickstarter is another one. These are more based on creative projects. This is not for businesses, causes, charities, or personal financing needs. Indiegogo is also primarily creative projects, but anything can be posted there. Rocket Hub is a newer one, and what's unique about Rocket Hub is their fuel pad and launch pad programs that help campaign owners and potential promotion and marketing partners connect and collaborate for the success of a campaign. AngelList is primarily for technology startup companies. Quirky is if you're an inventor, maker, or tinkerer of some kind, then Quirky is a place to collaborate and crowdfund for donation-based funding with a community of other like-minded folks. Their site digs deeper into helping the process of bringing an invention or product to life, allowing community participation in that process. So some tips: research the projects or causes you are interested in, especially reading comments. Look for transparency on how the money will be used. Know that it may be tough to get your money back. Also, consider starting off by only giving to people you know through these platforms. Don't be the first to give. Allow there to be some built-up legitimacy before you donate. Consider giving to campaigns run by third parties who don't immediately benefit from that donation. Avoid overfunding once a campaign has already reached its goal, and check if your donation is tax deductible. So any questions on crowdfunding? Right. Another newer one is peer-to-peer lending. These companies promise to revolutionize banking by stripping it down to the basics, connecting people who need money with people who have it to invest. These sites like Lending Club and Prosper enable people to borrow money outside of traditional bank loans. You are not borrowing from a financial institution, but rather from an individual or group of individuals. Peer-to-peer lending brings crowdsourcing to unsecured loans between individual lenders and borrowers. Kiva is one of the best-known charitable peer-to-peer crowdfunding sites. It focuses on empowering people to lift themselves out of poverty in over 77 countries. In most cases, the loans through Kiva are used to start or expand small local businesses. Meanwhile, Lending Club facilitates personal loans of up to $40,000, and investors can choose to invest in individuals or institutions. It is also the largest site of these peer-to-peer lending crowdfunding sites. Upstart focuses on the motto that you are more than your credit score. It says its underwriting software can help identify future prime borrowers based in part on their education and employment history, even if those applications have sketchy or limited credit at the moment. So peer-to-peer lending usually comes with higher returns than other types of lending. These websites greatly reduce the transactions cost of getting a loan, allowing borrowers to enjoy lower interest rates. And these sites usually help businesses and people access loans who otherwise may not qualify. So just be aware that the Securities and Exchange Commission, the SEC in the US, is wary of this field because these companies often sell unregistered and unregulated securities, aka the loans. But be aware that if you lend money through a peer-to-peer platform and the borrower stops paying, the loan money may go into a default and you may never get paid back. That's because your peer-to-peer investments are not FDIC insured. When you loan money through a peer-to-peer company, you can't tell whether you're getting paid enough for the risk and the risk that you're unwittingly taking. A percentage of loans will fail, and like a bank, your only recourse is to write off the loss. So one final section to go over is just some cybersecurity tips. Cybersecurity is important because it encompasses everything that pertains to protecting our sensitive data, our personally identifiable information, our protected health information, our intellectual property, and just overall our data from theft and attempted damage. In terms of mobile banking safety, look for a secure network. Avoid public Wi-Fi or hotspots when accessing your account. Hackers are known to sit on those public Wi-Fi spots and to intercept account info and passwords on those unsecured networks. You've heard this before. Choose a strong password. Use a unique mix of lower and uppercase letters, symbols, and numbers as required by your app. And don't share your login details with anybody else. Always be reviewing your statements to make sure everything looks in place. And just know that online banking is less secure than your bank's mobile app. Biometrics are here and they're here to help you. Look for two-factor authentication in your financial apps. Two-factor authentication is the second layer of security, asking for a second method to verify who you are. Although some mobile phone users are using face recognition or eye scans, more apps are likely to require this in the future. Many banks use a password and a PIN, or a fingerprint and a password. Know that the most pressing danger for lending donating at this time is being seduced into making a bad loan or a bad donation by a kind face and a good story. Again, remember, do your research. Put some thought into your PIN and passwords. Avoid using any form of your date of birth, social security number, or phone number. Don't keep it written down anywhere around you, but look for the password manager apps that will help you store and securely keep track of your PINs and passwords. For your online passwords, try not to use the same one twice. That way, if one is compromised, your other accounts won't be impacted. Something to think about is if your bank calls you, don't answer. Call them back. If you receive a phone call from your bank or someone saying they're from your bank, don't give any sensitive information. Even if the number on caller ID seems to be from your bank, caller ID spoofing can allow someone to seem like they're calling from a legitimate business. I always suggest Google searching that number. If your bank emails you, don't reply. Follow the same strategy and either start your own conversation by calling your bank through a verified phone number outside of the email to see if that email is really from your bank and why they emailed you. A tactic I love is a verbal password. This is another line of defense to stop someone posing as you. Ask your financial institution if you can put a verbal password on your bank account. These are mainly used for phone calls to customer service and for in-branch visits. And there's no way a hacker is going to know that very specialized, personable, verbal password. So some wrap up. A note on the pandemic, we have already discussed its impact on mobile banking, but where else could its impact be felt? Perception of cash as a vehicle for coronavirus could change how consumers choose to pay in person. Analysts say that psychological factor of people thinking of cash as unclean could prompt more adoption of things like mobile payment and mobile wallets. People default to what's familiar unless there's something to jolt you out of it, said Jody Kelly, CEO of the Electronic Transactions Association. Contactless payments have come up as a new option for consumers who are much more conscious of what they touch. Coronavirus impact on fintech is a double-edged sword. It will impact and increase usage, but could that increased demand increase the price? All of this will likely disproportionately affect the 26% of households in the US who are unbanked or underbanked and struggle to access those mobile services. Will we be walletless someday? With everything going on, people moving entirely to digital management of their financial situation, we might be walletless someday in our lifetimes. Also know that a few years ago, I was doing a series of classes at U of L, and I had jokingly asked some bankers, tell me when the bank branch no longer will exist. I was expecting some fanciful numbers like 100 years. Between the four bankers, the shortest amount of time was 10 years and the longest was 20 years. All of them said within 2 decades, bank branches will no longer exist. So any questions on this topic that I didn't cover today? Please know that this presentation and a post survey will be emailed to you later today. Our next certification class is dealing with debt on July 14th from 10 a.m. to noon. You can use this link to register on the cnpe.org website. And if you have any certification questions about this program or anything certification in general, reach out to me. That is my email address. That is the end of our session. I will hang out here for a few minutes in case you have any questions about this session or the certification program in general. If you have not already, did not put your name into the chat as a sign-in, please do so. And otherwise, thank you all for attending today and have a good day.